Hello and welcome everybody to my time frame alignment model series. It's going to be 8 episodes. It's going to be a full free course for you guys. But first of all, I want to thank the Inner Circle Trader for providing us with these concepts. I do not claim ownership of them. So thank you, ICT. And let's go to the syllabus. What are we going to be talking about in this series? First episode, open high low close and open low high close. This is the power of 3. Second episode, liquidity pools. We're going to be talking about where actually buy side and sell side liquidity is resting. Then the third episode, order pairing. This is going to be key in determining where the market moves. It always moves from buy stops to sell stops and vice versa. Then market cycles in the fourth episode. Fifth episode, order flow top down. This is going to be about daily bias. A lot of traders struggle with knowing where the daily candle will go. And this is hopefully going to unlock your understanding of that. Then we're going to be talking about the market maker model mitigation areas. This is actually where the high probability PT arrays form. And then we're going to be talking in the 7th episode about intraday profiles. Where does a session actually wants to trade towards, or where does it not need to trade toward, right? That's kind of question you want to ask yourself always. And then at the end, I'm going to show you how to execute your trades. And we're going to do that through simulation sessions with random dates as always. And I'll try to make it like a 1 hour or 1.5 hour long video. And then you should be fully set to use this entire model. So we're starting off with the power of 3, right? This is going to be our core framework. And before we start executing or determine our bias, we need to understand actually how those candlesticks are printing, right? Are they opening, going lower and then higher and then closing, or vice versa? You should be familiar with the power of 3. And if not, then I'm going to break it down in a few schematics later on with examples on the charts as well. And our understanding of where the market will move will be based on this concept always. So over here, we've got a schematic of an open, a low, and then a high and a close, right? This is a bullish candlestick. And I want you to think about that every single daily candle is either a bullish or a bearish candle, right? Typically, there can be no wick on the top or the bottom, right? That is possible, but 95% of all candles are all open high low close or open low high close. Now, knowing that is when 5 p.m. opens up that daily candle, right? We want to determine where the low of the day can be printed, and that can also be determined by using daily profiles. And I want you to understand that after the manipulation phase has happened, right, in the power of 3, the distribution phase is where we want to position ourselves, especially with a clear manipulation during London, for example, with a classic buy day profile. It's a way easier to determine where you want to enter. And I also want to focus on not entering too high in that daily candle, right? For example, let's say you're anticipating a bullish candle and manipulation has occurred, but the candle is already this high up. I want you to refrain from looking for entries, right? You want to look at close to the open or below the open. Now over here, we've got an open high low close candle, right? Same thing over here. You can see that in the schematic. Power of 3 is always accumulation, manipulation. That can occur during London or New York session, for example, but it can also happen during Asia. And then it's a little bit harder to determine the intraday profile, but we're going to talk about that in episode 7. I want you always to position yourself in the distribution of the candle. And we're going to be looking for an entry close to the open or above the opening. I don't want you guys to go all the way down here and look for the last little draw on liquidity. It makes it lower probability. Now with the power of 3, our understanding, we're going to be using the daily candles. And specifically, I'm going to be using 12 a.m. EST because ICT teaches that that is the true day opening. And this is where we actually can determine our daily profile. So if we can determine what kind of daily profile we are, we can also determine our draw on liquidity. We can determine if there already was a manipulation phase, so we can know in what stage of the power of 3 we are situated in and then act accordingly. So over here I've got a blank US dollar index chart, DXY, right? So over here, if I want to take your attention straight up to what kind of profile we're in over here, you always have trending markets or consolidating markets, right? So this is a bullish market profile. When you have a bullish market profile, I want you guys to never look for an open high low close candle, which is a bearish candle. This is counter trend, and if you just get rid of all the counter trend trades in your trading career, I think your win rate will increase significantly. I try to never go counter trend on the higher time frame, and if I do and the setup looks clean, I will do half risk. So put some lipstick on it, right? Over here, daily fair value gap, we can see price dipped back into the daily fair value gap, forming SMT on the lows, and now we can actually look to target those buy stops up here. Now, just for the sake of an example, I'm going to show you what that looks like intraday. We've got a blank chart over here, and let me put that lipstick on there, right? We can see the daily fair value gap. This is that blue box. Price moves away from it and then comes back into discount of the range it formed. Low of the day after the opening over here is formed during London in a key level here in the range after hitting a higher time frame key level. And then this is the body of the candle, right? So the body of the candle is that expansion phase in the power of 3, the distribution phase. It tops out above the buy side liquidity. That's the target hit. And then it closes, forming the open low, high and close of that daily candle. Now, this was a clean example of ICT's classic buy day. And notice how we went below 12 a.m. EST and then also created the low of the day from that daily candle over there. So over here, we've got NASDAQ. We're going to do a bearish example. I want you to determine the market profile first of all. It's just to see if you can see a clear trend or if it's consolidating. If it's consolidating, you want to avoid it. But you can see here is buy side of the curve and then sell side of the curve is kicking in over here. So if I put some lipstick on the chart, we had SMT on these highs up here and then a bearish order block formed, displacement lower and a break of structure. And there's sell side liquidity below this low. So that's what we eventually want to aim for, especially if price is back in premium of the range. You don't want to look for more buys and there's a drawn liquidity lower. Now, what does that look like intraday? If I put some lipstick on it again, we have the opening of that 12 a.m. EST over here. And if you notice something different in this chart, we have a daily profile high and then we have the candlestick high. So if we look at the power of 3 of a daily candlestick, the high can actually also be formed outside of a daily profile, which makes it a little bit harder to determine if we actually have the manipulation phase prior already. And this is going to be talked about in the intraday profiles lesson, but I want you to focus here on the candlestick opens up here around, I think for indices it's 6 p.m. EST, and the high of the day is already created with the opening, right? There's a small little wick over here, and then it's just continued downside for the rest of the day. When you're using a daily profile, you want to see a clear manipulation above 12 a.m. EST, but it doesn't happen on this candlestick's example, right? That's why I picked this example specifically. This is the body of the candle and the expansion lower. This is where the distribution phase of the power of 3 happens. And then the retracement and the close finishes off that open high-low close daily candle. Now, this was a perfect example of an ICT range to New York Open London close rally. Now, this occurs more frequently on indices. And why is that? Because on indices, the market is way more volatile when the stock market exchange opens. With Forex, there can be a lot of volatility during London. Indices sometimes have that as well, but it is way more likely that there's going to be a consolidation pre-market hour open. Now, specifically, I picked these examples because one of the charts actually makes the high or low outside of the daily profile. Now, this is where you need to be aware that manipulation can occur before 12 a.m. EST starts, and then the daily profile will be slightly distorted. So we got to apply a little bit of discretion when we look at these profiles. So not every day will be looking as clean as those schematics. And finally, we're going to be talking about a consolidation candle. And this is one you always want to avoid. So over here, we got the dollar chart again. We're still in a bullish market profile, but you can actually see, and I want to take your focus over here, that this area is consolidating. I'm going to be talking about market cycles as well. And that is going to be also amazing to determine if we were actually going higher or reversing. But I want to take your attention to this range high to range low and how the candlesticks are resting within this candle's range. Now, this is an extended consolidation, and the number one reason why price consolidates is because of time. Time is more important than price, and ICT also always talks about that time comes before price. The economic calendar will be your roadmap into determining what is the right time to trade and when to avoid trading. What does that look like intraday? We've got that range high to range low here. So if you look at the open on 12 a.m. EST over here, you can see price continuously dips above and below that daily opening price, right? Open, low, high, close. It's all very tight, and the close is almost at the same price level as the open. This is a classic example of an ICT seek and destroy profile. And the number one reason, like I stated earlier as well, that this is the economic calendar has so much to do with this. So think about when there's a bank holiday, when there is a massive range previous day, and then price needs to consolidate to build up orders as well. That's also when it can consolidate. Always look at the economic calendar as your roadmap and when to trade or when not to trade. If you do not take in account time, you will not be trading in the best market conditions possible. Time comes before price always. Now, to quickly summarize what we've discussed, the power of 3 is key in determining how any candle forms, and we're going to be focusing mainly on the daily candle, but the power of 3 also happens on a weekly candle. And then we can talk about the weekly profile. When is the low of the week being printed? And then we can use the daily candles to determine when or where that forms. I want you to always keep your eye on the economic calendar. Third of all, the lower time frame doesn't print as clean as a schematic. So be aware of that and be focused when you look at those charts and look at the details. If you enjoyed the first episode, guys, make sure to subscribe. As always, I will drop one video every week in this series. Like and comment if you can, helps with exposure, and I will see you guys in